The average American in their 40s will pay over $400,000 in federal income tax before they retire. 400,000. That's a house. That's 15 years of maxed out retirement contributions. That's generational wealth evaporating into the federal budget. And here's what keeps me up at night. Most of that money didn't have to leave your pocket. Today I'm showing you exactly why tax optimization isn't optional once you hit 40. It's the single highest ROI financial move you can make. And I'll give you the specific strategies that separate people who retire wealthy from people who retire wondering where it all went. Let's get into it. First, we need to talk about why your 40s are fundamentally different from every other decade of your financial life. In your 20s and 30s, you were building. Lower salary, maybe some debt, figuring things out. Tax optimization existed, but the stakes were smaller. Miss a strategy, you're leaving maybe a few thousand on the table. But your 40s, this is the financial pressure cooker. You're likely in your peak earning years or approaching them. According to the Bureau of Labor Statistics, earnings peak between ages 45 and 54. That sounds great until you realize something brutal. The U.S. tax system is progressive, which means every additional dollar you earn gets taxed at a higher rate than the last. You worked 20 years to get that raise. The IRS takes a bigger percentage of it than anything you earned before. That's not a bug. That's the system working exactly as designed. Here's the pattern interrupt you need to hear. Your income is a river, taxes are a dam, and most people in their 40s have zero drainage strategy. They just let the water build up and overflow straight to the government. Stop doing that. Now let me show you the 3 accounts that most 40-somethings criminally underutilize. Number 1, the HSA, Health Savings Account. If you have access to one and you're not maxing it, you're making a mistake. This is the only triple tax advantaged account in existence. Contributions are pre-tax, growth is tax-free, withdrawals for medical expenses are tax-free, and after 65, it functions like a traditional IRA for any expense. In 2024, you can contribute $4,150 individually, $8,300 for families. That's money that never gets touched by federal income tax, if you play it right. Number 2, the Mega Backdoor Roth. Most people don't know this exists. If your employer's 401k plan allows after-tax contributions and in-service withdrawals, you can potentially funnel up to $69,000 per year into Roth accounts. That's $69,000. Compare that to the $7,000 regular Roth IRA limit. The tax-free growth difference over 20 years is hundreds of thousands of dollars. Number 3, the solo 401k or SEP IRA. If you have any self-employment income, side hustle, consulting gig, freelance work, that income can fund retirement accounts far beyond what your day job allows, and those contributions reduce your taxable income dollar for dollar. Now here's where your 40s create a unique window that closes forever. At age 50, catch-up contributions unlock. You can add an extra $7,700 to your 401k, an extra $1,000 to your IRA. This sounds small, but compounded over 15 years to retirement, we're talking 6 figures of additional tax advantage growth. But here's what nobody tells you. The years before 50 are when you should be building the infrastructure, getting the right accounts open, understanding your plan's rules, maximizing your base contributions so that when 50 hits, you can immediately pour in the extra. Most people wait until 50 to start thinking about this. Then they spend 2 years figuring out the logistics. They've wasted 20% of their catch-up window. Don't be most people. Let me give you the real math that should make this urgent. Assume you're 42 earning $150 annually in the 24% federal bracket. If you implement proper tax optimization, maxing pre-tax accounts, utilizing HSA, strategic Roth conversions during lower income years, you could reasonably reduce your effective tax rate by 4 to 6 percentage points. On 150, that's $6,000 to $9,000 per year. Over the 23 years until you're 65, that's $140,000 to $207,000 kept in your accounts instead of sent to Washington. And that's before we factor in the compound growth of those savings. This is not about being anti-tax. Taxes fund civilization. This is about not paying more than the law requires because you didn't understand the playbook. So here's what you do this week. 1. Pull up your last pay stub. Look at your 401k contribution. Is it maxed? If not, calculate what percentage increase gets you there. 2. Check if you have HSA access. If yes, verify you're contributing the maximum. 3. Ask your HR department one question. Does our 401k plan allow after-tax contributions and in-service rollovers? That one question could unlock the mega backdoor Roth. 4. If you have any self-employment income, schedule a call with a CPA who specializes in small business retirement planning. These are not complicated moves. They're just moves most people never make because nobody told them. Now you've been told. Your 40s are the decade where financial decisions compound dramatically, in either direction. Optimize now and you're building a fortress. Ignore this and you're funding someone else's priorities with your peak earning years. If this video gave you even one actionable strategy, hit subscribe right now. I release new data-backed finance breakdowns every week, strategies that actually move the needle on your net worth. Subscribe, and I'll see you in the next one.